Hi all Inderes TV viewers. Mandatum released their Q4 results last week, and today we'll discuss about the company with our analyst Kasper Mellas. Hi Kasper.
Hi.
So Mandatum's Q4 was rather good, but the result was a little bit below our estimates because of some accounting technical factors. Could you tell more about how the Q4 went and what were these accounting technical factors?
Yeah, well, for the capital light business, the quarter and the full year was rather good. The assets under management grew a bit higher than we anticipated in Q4, which was also obviously a positive thing. But then in the with profit business, the net financial income was a bit below our estimates. That was because the discount factor effect, which is just a technical thing related to the balance sheet and income statement. So the negative effect was a bit higher than we anticipated, but it was only a one-time thing, and then the result moves in line with the interest rates and discount rates, so that wasn't that significant. So all in all, the performance was rather good and quite in line with our expectations.
Okay, so let's talk about profit distribution. What was the dividend proposal and was it in line with our expectations?
Well, the dividend proposal was 33 cents, and it was in line with our expectations, so no surprises there. Of course, the company had stated that they're going to distribute 500 million euros in the next 3 years, so it was also the dividend proposal was in line with that too. So I don't think there was really a surprise factor there.
Yeah. Well, Mandatum's solvency decreased from the previous quarters. Could you tell us more about this, and does it have an impact in our profit distribution forecasts?
Well, there are several things that had an effect. First of all, the dividend proposal. Then there was a loan of 100 million, approximately 100 million from Sampo Group that came when the two companies made the merger. So that had a negative impact on the solvency ratio. And then the third important factor was equity risk, which when the equity indexes go higher, then the regulator requires a higher buffer in the solvency ratio. So that had also a bit negative impact, which resulted in a bit lower Solvency II ratio than we have anticipated beforehand, but the difference wasn't as significant, so that didn't change our profit distribution estimates at all. So we had calculated sort of buffer, so we didn't expect all the excess capital to be distributed to the shareholders. So we didn't see any reason to make any changes on our estimates.
Yeah, okay. So what did Mandatum's outlook and guidance for this year look like, and was it in line with our expectations?
Well, the company estimates that its fee profit is going to be higher this year than the previous year, which was in line with our expectations. We have estimated that as well. So the guidance wasn't a surprise, but then again, it didn't say how much higher. So the information value wasn't that high, which was also expected. So no surprises there as well.
Okay. Well, lastly, what does our expectations and recommendation look like at the moment?
We have a buy recommendation, which means that we believe that the real value of the company is higher than the current share price, and our target price is currently at 4.40 euros. This is based on our dividend discount model, which takes into account the excess capital and profit distribution, and also the expected development of the operational segments as well. So all in all, we think that the company is currently undervalued, and the profit outlook for the investors is rather intriguing, I'd say.
Okay, good to hear. Thank you, Kasper, for the answers.
Thanks.
And thank you all Inderes TV viewers. If you're interested to read more about Mandatum as an investment, make sure to read our reports at inderes.se. And also we have a more in-depth video about the company, which is linked in the comment section. Thank you for watching. See you on the next videos, and remember to read analysis and make good investing decisions in the meanwhile.